With rising interest rates, the highest inflation in 40 years, and recession being a common buzzword on all media outlets, it's helpful for investors to seek a balanced portfolio that can help hedge against this economic turmoil. This is where dividend growth ETFs come in, to offer a hedge against bear markets and increase passive income in the form of dividends. Since 1974, dividend stocks returned 9.25% per year, beating the S&P 500's return of 7.7%. Even more startling, non-dividend stocks returned only 2.6% annualized returns. While dividend stocks may seem boring, their outperformance speaks volumes. Hey Raylenaires, in this video we will discuss what dividend growth ETFs are, the key metrics we look for to value them, how using a long-term strategy with ETFs can provide greater returns than the S&P 500, the top 3 dividend growth ETFs to buy and hold forever, and be sure to stay until the end of this video to see the portfolio update of what I'm buying and selling and why. This is an interactive invest with me to retire early. I'm trying to retire in 10 years with $8,000 a month portfolio. So if you would like to invest with me, click the link in the description below to get the free dividend tracker Excel sheet so you can easily track your dividends on a monthly and annual basis. It's no secret that dividends can provide a faster way for you to retire early and hedge against market crashes. What I love about dividend stocks is the passive income you can generate from simply owning a company. For example, if you own one slice or share of the company Johnson & Johnson, management will reward you with cold hard cash for simply owning a part of their company. For Johnson & Johnson, they have paid investors this cold hard cash or dividends quarterly for 56 years straight. If you owned one share of Johnson & Johnson, you would get $4.52 each year on top of your principal. Not only does Johnson & Johnson pay dividends quarterly, but they have also increased their dividends each year as well. Companies that have a solid record of increasing their dividends on an annual basis are known as dividend growers. These dividend growth stocks are generally well managed and financially sound. The ability to sustain and increase the dividend each year often shows a company is increasing profitability and generating solid cash flow. Companies that show dividend growth are normally stable companies that have been around for at least 10 years. Companies that have paid and increased dividends for 25 years or more are known as Dividend Aristocrats. Companies include AbbVie, Coca-Cola, and McDonald's. Companies that have paid and increased dividends for 50 years or more are known as Dividend Kings. Companies include 3M, Target, Lowe's, and Stanley Black & Decker. Owning dividend growth stocks can help give you peace of mind due to their impressive track record. Dividend growth ETFs, or exchange-traded funds designed to invest in a basket of dividend-paying stocks, seek to provide investors stable returns from well-established companies. Instead of owning individual dividend growth stocks, investors can buy into one low-cost fund that owns many well-established dividend growers. It's like owning a mall instead of one store. Warren Buffett once said, if you want the recipe for getting rich, find stocks with above-average appreciation potential and safe and growing dividends, and buy them at attractive prices. One major benefit of dividend growth investing is getting passive income during bear markets. During the 1970s and 2000s, dividends accounted for over half of the market returns. This happens during years of declining or stagnant markets. If you own a non-dividend growth stock for 10 years like Facebook or Meta, and you see the price and company increasing for 9 years, but on the 10th year there is a bear market and all of your gains are wiped out, you have no return for all of your conviction and patience. If you need that money for retirement or to buy a house, this risky asset may not provide the returns you want when you need the cash. If instead you bought a quality dividend growth ETF, you would get increased cash each quarter that you can reinvest to create a compound snowball effect and end up with twice as much income in 10 years' time. For example, if you bought 100 shares of AbbVie, ticker symbol ABBV, at $153.62, and the stock price didn't go up at all in 3 years, which would be very highly unlikely for this company. If you reinvested dividends, you would end up with $2,315.83 just in dividends. Another benefit, as stated earlier, is dividend growers outperformed the S&P 500 from the 1920s to 2014 in annualized returns. This is due mostly because dividend-growing companies are often stable, cash-rich businesses that are more conservative on their balance sheet. Dividend aristocrats and kings are very selective in where they manage money, so they can maintain their dividend status. If a dividend is cut, the stock price normally falls, and management's stock compensation and investments in that company falls with it. A company that pays dividends is often more disciplined in gaining safer and higher yielding returns than non-dividend growing companies. Thus, with the stock market, slow and steady really does win the race. Last, many financial gurus will tell you to use the 4% rule in retirement. This means selling 4% of your portfolio each year to live off in retirement. Thus, your principal dwindles and you only have a limited amount of time to withdraw these investments. Instead, if you put your money into dividend growth stocks, you would maintain your principal and you could get more money each year. This means you could live more comfortably in retirement and you could create generational wealth for your loved ones. Many investors find dividend growth ETFs as a great strategy to balance a portfolio. With dividend growth ETFs, the stock price generally doesn't fall as much as riskier assets, and you have steady income to hedge against bear markets. I also personally enjoy seeing increasing dividends to hedge against inflation and recessionary fears. So now that you know why investors love dividend growth ETFs, here are the top metrics we need to look at when investing in dividend growth ETFs to get the best bang for your buck. We need to look at the dividend strategy, dividend yield, dividend growth, and expenses. For strategy, we want to see what type of dividends they own. We want stable and high-quality, low-risk companies that have increased dividends for a few years running. We are looking for a well-diversified portfolio with low percentage of exposure for all holdings. We are also looking for low payout ratios, excluding REITs. Payout ratio just means how much the company earns compared to the dividend they pay. The lower the payout ratio means generally the higher the probability the company can sustain and or grow the dividend. Real estate investment trusts are obligated under law to give investors at least 90% of their earnings, so payout ratio is higher for REITs. While past performance doesn't guarantee future performance, we will get a sense of how this fund is managed. Second, we want to see a stable dividend yield that has been running consistently for about 10 years. We're not looking at new ETFs because there isn't much of a track record for me personally to invest. We want to see a dividend yield between 1 to 4% because this is sustainable for most blue chip stable companies. We also want a higher return than the S&P 500. Keep in mind the dividend yield will change with the stock price. If the stock price lowers, the dividend yield will usually increase to compensate for the share price. This is great for investors who are worried about a market crash. Third, we need to see dividend growth that is increasing steadily and not cutting the dividend too frequently. If we see the ETF increasing growth over a 10-year period, we can note that this may be a good indication of future dividend growth. Fourth, we need to look at expenses. The expense ratio of an ETF is the total percentage of fund assets used for administrative, management, advertising, and miscellaneous expenses. It's like paying a fee to manage the ETF you invest in. We are looking at low-cost expenses because fees can add up and eat away at returns. Mutual funds tend to have higher expense ratios because they are actively managed. ETFs, according to Morningstar, have an average 0.23% expense ratio, while mutual funds have an average 1.45% expense ratio. This means it will cost you $1,358.95 to invest $10,000 for 10 years in a mutual fund, while it will only cost you $227.63 for an ETF. That's over $1,000 in savings by doing nothing. With these metrics in mind, we will look at the top 3 dividend growth ETFs to buy and hold forever. The first dividend growth ETF to buy and hold forever is ticker symbol VIG, or the Vanguard Dividend Appreciation ETF, which is the most well-known and largest dividend growth ETF by Vanguard. It tracks large cap equity, emphasizing stocks with a record of growing their dividends year over year. It seeks to track the performance of the S&P US Dividend Growers Index. This index measures the performance of U.S. companies that have consistently increased dividends each year for 10 years. The index excludes the top 25% highest yielding eligible companies, as these higher yields tend to be riskier. The ETF is currently at $145.58 with a negative 14.43% yield-to-date return. For the past 10 years, VIG has returned 11.97% on average each year, and since its inception in 2006, it has returned 8.92% each year. Its 52-week low is $138.61 with a 52-week high of $172.16, and it has a dividend yield of 1.93%. It has a market cap of $144.7 billion with 289 stocks currently in its portfolio. It has a PE ratio of 19.4 and return on equity of 24.2%. It is well diversified with its largest sector in information technology at 22.9% and financials at 14.7% exposure. Each holding represents less than 5% of the total portfolio. Top 10 holdings include United Healthcare at 4.21%, Johnson & Johnson at 4.08%, Microsoft at 3.87%, Procter & Gamble at 3.04%, and JP Morgan at 2.89%. Since 2013, VIG has increased dividends consistently from 34 cents to 69 cents, which is of course double. Dividends over a long trajectory has increased. In 2013, it was 34 cents, 2015 it was 44 cents, 2017 it dropped to 42 cents, 2019 was 51 cents, 2021 it was 51 cents again, and currently it is 69 cents. While this seems a bit sporadic, if we look at a graph, we can see a clear upward trajectory of dividends to hedge inflation. For the past 10 years, we can see a smooth dividend growth rate as well. The 10-year dividend growth rate for VIG is 8.76%. Assuming an annual dividend growth rate of 8.76%, dividends will double every 8.5 years. VIG clearly has a great track record of consistent and increasing dividends. Now let's look at the expense ratio. Vanguard is widely used by investors who are known as boggleheads, which includes me, who love low-cost funds. This ETF is no exception to Vanguard's legacy. The expense ratio is the lowest one we have on this list at 0.06%, meaning if you invested $10,000 into this ETF for 10 years, the cost would only be a measly $59.84. I do have to note that the stock price appreciated over 20% the past 3 years, and therefore the dividend is lower than the ideal 2 to 4% that many companies offer. This is personally fine for me because if the price drops, the dividend will increase. This is a great ETF to own if you're looking for a safe, low-risk ETF. The next top dividend growth ETF is DGRO, the iShares Core Dividend Growth ETF. It offers low-cost exposure to U.S. stocks focused on dividend growth. It seeks to track companies that have a history of sustained dividend growth and are broadly diversified across industries. The benchmark it uses is the Morningstar U.S. Dividend Growth Index, which owns companies that pay qualified dividends with a minimum of 5 years of continuous annual dividend growth and have a significant margin to continue growing dividends. They exclude the top 10% dividend-yielding companies, and the payout ratio must be less than 75%. Only positive consensus earnings forecasted companies get exposure to this index as well. It is currently at $48.27 with a yield-to-date return of negative 13.56%. Average annual return is 11.3% over a 5-year period. It has a 52-week low of $45.52 with a 52-week high of $56.42 and a dividend yield of 2.32. Note that while this is a newer dividend growth ETF, with its inception date in 2014, it does currently offer a better yield than VIG. While the annual total return is even with VIG around 20%, it seems excluding the top 10% instead of the top 25% is currently creating a higher yield for DGRO. This may mean it's a bit riskier than VIG as well, though. Net assets are $21.86 billion with a total of 414 holdings, so a little bit more diversified than VIG. It has a PE ratio of 15.89 and is well balanced with 20.14% exposure to information technology and 19.17% exposure in financials. Each top holding accounts for less than 4% exposure in the portfolio. This includes Apple at 3.03%, Microsoft at 3.01%, Johnson & Johnson at 2.89%, Procter & Gamble at 2.73%, and Pfizer at 2.69%. Since 2014, DGRO has steadily increased dividends. In 2014, it was 16 cents, 2018, it was 19 cents, 2020, 24 cents, and 2022, it was 26 cents. Note that all of these ETFs did pay dividends during 2020 and did not cut these dividends. With the exception of 2015, we can see a slow dividend increase over the past 8 years. For the past 5 years, the dividend growth rate has been 10.4% each year, which means dividends double every 7 years. With consistent and increasing dividends, let's look at the expense ratio, which is a low 0.08%. This means you would pay $79.71 for a $10,000 investment for 10 years owning DGRO. If you're looking for a higher yield, albeit a bit riskier, DGRO is a great option. The last top dividend growth ETF to buy forever is NOBL, NOBL. This is the ProShares S&P 500 Dividend Aristocrat ETF, which is the only ETF that focuses exclusively on the S&P 500 Dividend Aristocrats. These are high-quality companies that have paid and grown dividends for at least 25 years, with most doing so for 50 years or more. NOBL selects mostly household names that generally have stable earnings, solid fundamentals, and a strong performance of profit and growth. It has a history of weathering bad economics while capturing most of the gains of bull markets. It tracks the S&P 500 Dividend Aristocrat Index, which contains 40 equal-weighted stocks, and has a diversified portfolio of sectors not exceeding 30% of the fund. It is rebalanced every January, April, July, and October to meet the fund's requirements and lower risk. Current market price is $85.85 with a negative 12.32% yield to date. For the past 5 years, NOBL has returned an annualized 10.49%, and since inception in 2013, annualized returns are an impressive 11.32%. It has a 52-week low of $81.78 and a 52-week high of $99.75, almost up to 100, with a dividend yield of 1.85%. Net assets are $9.58 billion, and it holds 64 companies in its portfolio. It has a market cap of $90.28 billion with a PE of 19.16. Top sectors include consumer staples at 21.17% exposure, and industrials at 18.94% exposure. All holdings are highly diversified with less than 2% exposure into one stock. Top 10 holdings include NextEra Energy at 1.84%, McDonald's at 1.76%, IBM at 1.75%, Pepsi at 1.71%, and AbbVie at 1.71%. While there are less companies in this portfolio, there's a lower concentration in each position, making this well diversified. Since 2013, NOBL has consistently increased dividends. In 2013, it was 13 cents, 2016, 20 cents, 2018, 24 cents, 2020 was 34 cents, and it currently is at 38 cents. Since 2014, dividends have been slowly increasing steadily. Its 5-year dividend growth rate is 7.31% per year. This means dividends double every 9.8 years. It's important to note that the dividend growth rate is lower than the other two ETFs, so the snowball effect will take longer than VIG or DGRO. Dividend aristocrats tend to be safer but grow at a slower pace than dividend stocks that have only paid for 5 to 10 years. Now let's look at expense ratio, which is 0.35%. So while the stock price has outperformed this ETF, the expense ratio and lower dividend growth rate creates a more level playing field. If you invested $10,000 in NOBL after 10 years, you would pay $344.54 in fees. If you want a very secure dividend growth ETF, the slower growth and expense may be worth the performance. Also, if you want to invest in current and future dividend aristocrats, but don't know which one to select, this is a great passive way to invest in them. So now that you know the top 3 dividend growth ETFs, let's talk about how we can use these to get better returns that are low risk. The biggest cause of market underperformance is timing the market. An investor will buy at a current stock price and especially during market turmoil may sell at much lower prices. Worrying about the stock price instead of being able to get passive income each month can test even the most patient investor. Thus, having a long time horizon, especially with these 3 ETFs, will cause better annualized returns. From 1969, when we went to the moon, to 1993, missing the market's best 90 days would have resulted in 20 times worse total returns. What's even worse is since 1926 to 1990, missing out on the market's top 7% performing months would have created a total return of 0%. To succeed in this market, you really need to have a long-term buy and hold strategy. It's easier to do this when you get paid to hold your shares. Another strategy that I personally use with these ETFs is to buy DGRO with the highest dividend yield while investing 10% exposure into individual Dividend Aristocrats. If you want higher returns and have time to research, choosing the best Dividend Aristocrats can reduce expenses and create more income. Without NOBL's expense ratio, you can save a few $100s. I like investing in AbbVie with a 3.38% dividend yield, NEE with a 1.96% dividend yield, and Target with a 1.85% dividend yield. While this strategy is of course riskier, you could potentially see higher returns. So now that you know the top dividend growth ETFs to buy and hold forever, what are your thoughts? Do you like these ETFs or do you prefer individual stocks? Let me know in the comments below and leave a like so the algorithm can find investors who want to maximize returns. It's time to invest with me with my weekly updated portfolio. I will discuss my dividend totals, what I bought and sold and why, and what stocks I will be buying next week. As a disclaimer, this portfolio is only 10% of my total dividends, and I mostly invest in SPY, SCHD, VYM, and DGRO. This is a high-yield dividend portfolio combined with dividend growth. I am looking to get $1,000 a month in dividends as a goal, and I'm slowly balancing out my portfolio. I would like 50% high yield and 50% dividend growth. As always, this is not financial advice. I'm just an NYU finance student on YouTube sharing my life. While this week was very rocky with several earnings reported and Europe expecting to increase its interest rate for the first time since 2011, the total portfolio is up a bit to $48,724.85. Yield to date, it is negative 17.04%, which is beating the S&P 500 at a yield to date of negative 19.46% return. Total earned dividends are $2,854.28. Let's add dividends to our tracker. So this is super easy. I go to the cell next to July and add total dividends. I got 6 cents from Ben. IPR, I got 44 cents. Maine, I got 6 cents. Stag, I got $7.22. STWD, I got 20 cents. Store, I got 38 cents. And Maine again, I got $13.12. I'm not sure why I got double. Last week, I got a total of $21.48. So for July, I will type in $164.84. You will notice the graphs adjust to this number as well automatically. I reinvested all of these dividends into ticker symbol MO or Altria and EPD. So I bought $10 worth of MO and $11 worth of EPD. If you would like to see why I love these 7% yield dividend growers, I will add a link to the description below. Let's go back to the tracker. I only add full shares to my template, but basically once all of the stock information is filled, I would update my number of shares. Last week, I talked about my favorite consumer dividend growth stock, which is Costco. I will leave that video in the link in the description, but you will see it is in yellow because it is on my watch list, but the price is too high for me. I currently have a high exposure in high yield ETFs that I created in November of last year because dividend growth stocks were getting too high in value. In the coming months, you will see less exposure to high yield and more exposure to dividend growers because the stock prices are near my buy zones. Currently, QYLD is 30% exposure and JEPI is 23% exposure. I'm very excited to buy EPD since their dividend is coming up soon. MO is also in my buy zone at current levels. I'm looking to buy more Main or Main Street Capital, especially if housing starts cooling off and the price goes lower. And while Stag is a great company, I'm just going to hold it. Stag has a dividend growth rate of 0.85% for the past 5 years. To put that into perspective, Maine has a 5-year dividend growth rate of 2.9%, which is almost double. I believe even though the price is climbing back up, the almost 7% yield that appears sustainable is a good buy. I did want to speak about IIPR. Last week there was a default by one of its big renters. While this may seem shocking, FFO is currently 10x, and according to 8 analysts, it should grow at an 11.4% CAGR over the next 4 years. So while this default accounted for $2.2 million, or less than 1% of total revenue, IIPR looks like a high-risk buying opportunity, as long as you have exposure less than 1%. So while I'm not looking for more exposure in this high-risk stock, I will continue holding. Total dividends for this year are $4,860.55 currently, and I need $12,000 to get to my goal. I didn't deposit anything into this account this week because I wanted to buy more SCHD in my Webull account. I will continue to reinvest and deposit into this account this year, but I'm slowly trickling into dividend growers because I believe we still have many red days ahead. While seeing inflation data looks like it's peaking and consumer sentiment is growing, I believe the market is still a bit spooked about a recession. So now that you know what stocks I'm buying and selling, let me know what stocks you bought this week or will be buying next week. Or if you're not buying anything, why? If you would like the Excel sheet, use the link in the description below and click the video that shows you exactly how to use it. As always, this is Supergirl Investor here to save the world and make you wealthy. Yes, you look like $1 million. And I hope you really enjoyed this video about the top 3 dividend growth ETFs to buy and hold forever and why you should do so. And I hope you liked the portfolio update. Please let me know in the comments what you would like to see next as far as stocks I should analyze. And please be happy, healthy, wealthy, successful, and safe. Please have a wonderful week, both financially and healthy. I love each and every one of you. Bye.